The demise of American exceptionalism, a troubled Chinese economy, and a falling US dollar.
The currency is grappling with a crisis of confidence.
As US markets continue to weaken,
Fear and confusion drives a flight to safety and a modern-day gold rush.
About 6 months ago, we were expecting that for the financial year 2026, earnings for the overall ASX 200 would grow only by about 3%. Now, 6 months later, the expectations for that FY26 earnings growth sits above 10%.
The price of Australia's biggest export, iron ore, remained resilient, largely above $100 a tonne, boosting the bottom lines of BHP, Rio Tinto and Fortescue. Gold miners like Newmont rode a once-in-a-generation boom.
They should get a proper earnings boost when you see an uplift like this.
More importantly, where there's plenty of cash on the balance sheet, I think we're going to see some surprises again in terms of dividends.
And cash poured into data centres for companies like NextDC, but analysts warn it could soon dry up.
It's an interesting play. There's certainly extraordinary growth built into forecasts, but they had perhaps run a bit hard.
Data centre development is inevitably going to hit delays. We know that the water requirements for cooling are just can't be accommodated by Sydney's water storage. And so there is going to be some slowdown to the hopium that's been priced into many of these AI-related stocks.
While the tech race hits a speed bump, the competition for shoppers' dollars heats up in the supermarket sector, with Woolies expected to come under pressure from rivals Coles and Aldi. And analysts expect higher incomes to push sales up.
Our work indicates that the wealthier households have increased their ability to spend by so much over the last few years that it overall masks the negative impacts which the renting households are facing.
Official data shows shoppers hit the high streets for Black Friday and Cyber Monday sales and pulled out their credit cards over Christmas. But that spend-a-thons helped push the Reserve Bank into its first interest rate hike in 2 years, with the potential for more to come.
Gemma Dale reckons that'll crimp spending, hurting discretionary stocks like JB Hi-Fi, Harvey Norman and...
You can look at one of the big ones like Wesfarmers, for example, and go, what's happening at the lower end, the less expensive retailers like Kmart and so on? Are we starting to see a shift into less expensive items, that sort of thing? So I think there'll be a fair bit of interest in that.
While interest rate hikes pinch shoppers' hip pocket nerves, they'll boost banks' bottom lines.
It's largely a product of the fact that about 3 months ago we saw a pivot towards interest rate hikes, which we've now seen.
The wild card this reporting season, analysts say, is the healthcare sector, especially CSL, which shocked investors last time around with surprise job cuts and spin-off of its vaccine business, which has been delayed.
Investors do love that stock if they've held it for a long time, but it's so weak and they're looking for some turnaround. Earnings growth is still there, but it needs to be strong. They need to see the sales growth. They need to see management nail the story about how they're getting back on track. That's what they really want to see.
An earnings season set to trump expectations.